Hi, everyone, and we'll just give everyone a minute or so before starting to allow all attendees to come through from the waiting room. Hi, everyone. This is Chris Lethbridge from the China-Britain Business Council. It's great to have you all online for today's CBBC webinar. We'll be exploring the insights from the China CEO Outlook. Before we begin, I'd just like to remind you that if you have any questions you'd like to submit, please use the Q&A function at the bottom of your screens. So over the course of the pandemic, KPMG has been conducting 3 surveys of over 1,300 CEOs from across the world to understand their views of COVID-19, so to understand the impact of COVID-19 on their businesses and the broader economy. Today, we're going to be joined by Mark Harrison of KPMG China, who will outline the key takeaways from the survey results of 125 CEOs polled in China. This webinar will look into what China CEOs are focused on to drive growth in the organization and how this compares to their global counterparts. To help set the scene today, I'd also like to introduce my colleague Torsten Weller, who will provide a brief introduction, followed by Mark and Matt from KPMG, who will talk through the findings of the survey. So without further ado, let me hand over to Torsten.
Thank you, Chris, and good morning and good afternoon. To all the participants. Thank you for joining. My name is Torsten Weller. I'm the London-based China policy analyst at the China-Britain Business Council. And before I hand over to Mark, let me briefly give you an overview of where we are at the beginning of 2022. So 1 year ago, things looked very positive. China was basically the only major economy that had positive growth in 2020, the first year of the pandemic. And everybody was expecting that this positive development would continue in 2021. And then things turned out to be slightly different. First, we had what many called a regulatory storm engulfing China's tech sector and its tutoring industry. Then we had an energy crisis, forcing many companies in China to cut production or even shut down completely for a couple of weeks. And finally, we're seeing increasing stress in China's property sector, which in the past accounted for nearly 1/3 of China's GDP growth. And on top of that, we have still the uncertainty caused by the ongoing COVID pandemic and the local lockdowns that we're seeing in Xi'an and now in Tianjin. But there are also very positive developments. First of all, the growth in advanced manufacturing and high-tech industries outperform the other more traditional industries. In the first 11 months of 2021, we saw growth in high-end high-tech industries increased by 90% compared to 10% for all industries. And if we look at specific industries, then the growth in the production of industrial robots increased by 49%. So that indicates that we will see continuing productivity growth in the near future, which is one of the main drivers of economic growth. Foreign investment remained at record levels. We crossed the 1 trillion yuan threshold in November, meaning that we are on track to surpass the record levels of foreign capital inflows that we saw in 2020. And notably, investment in services also increased. Investment in high-end professional services increased by nearly 21%, which is also a very positive signal and means that China is on a good path transitioning from the export-led and manual labor industry towards a more high value-added industry. When we look at UK-China trade, then we see some positive signals as well. To be true, overall export levels remain far below the record levels that we saw in 2019. But if we look at consumer goods and capital goods, then there are clear positive developments. So if we exclude oil and non-monetary gold, then exports from the UK to China actually increased by 15% in the first 10 months of 2021. That follows on an already increase in 2020. So China remains a very important market for UK goods. especially as the UK is now charting its own way outside of the European Union. So summing up all these findings, it is important to not just look at the headlines that we see in most Western media, but to actually look at what is happening on the ground. And that's why it's so important to have these surveys and speakers like Mark Howson. And so without further ado, let me hand over to Mark and Matt to share the findings. Thank you very much.
Thank you, Torsten. Good morning, good afternoon, everybody. I'm a deal advisory partner at KPMG in Shanghai. Been based here for the last 14 years, advising multinationals on investments and joint ventures in China. So I think if we could put up the materials, please, Chris, I can start to talk through the findings. Just maybe a bit of background first. We've been doing these surveys for a number of years now, kind of starting just before the pandemic and then updating them every 6 months or so. As Chris explained in the beginning, this is a survey of global CEOs. So we have several reports. One is the conclusions of the global CEOs, so everybody together. Today's presentation is basically an extract of that data, which regards, is about the opinions of the CEOs of Chinese companies. Just to be very clear, it doesn't include, for example, the China CEO of a multinational in China, the Chinese operations. It's truly Chinese companies, global Chinese companies and their CEOs. And this recent survey was conducted in July and August, which I'll come back to in a minute, because as Torsten mentioned, China last year was a bit of a story of two halves in terms of what happened in the first and second half of the year. So maybe little Chris Wiki style, next slide, please. So we've got 9 findings to share with you. Matt will jump in the middle to focus on some points about ESG. So first of all, you can see 2 graphs here regarding how Chinese CEOs think about the Chinese economy. Bottom left, you can see back in January and February, that was relatively high. I think that was taken just before the outbreak of COVID, and then of course dropped into the summer of 2020, then rebound quite rapidly at the beginning of 21, and then slowed down a bit in the middle of last year. Now, what's driving that is, as we've talked about, the Chinese economy rebounded very quickly out of COVID and came out of lockdown very fast, very much export driven. We're still waiting to see a full recovery of the consumer sector. However, during the year of 2021, we were hit by a number of factors. The tech regulatory issues that Torsten was talking about, the Evergrande property problems, and then some power cuts that happened later in the year due to some mostly supply side problems, which caused a number of factories to be closed, often with very little warning. What's interesting is if you look on the graph on the right-hand side, is the change in the views of Chinese CEOs about the global economy. So the top 2 bars, where it says China, that means the Chinese CEOs and what do they think about the global economy. So back in summer 2020, their confidence was only 10%, but by summer 21, that had boosted to 56%. And that's driven quite simply by the success of the vaccine rollout globally. What you can see that the difference for the global CEOs is less. They were already kind of 32% confident, and that increased to 60% by summer 21. Move on, please, Chris. Now, the next big factor is basically innovation and R&D, and this is the big story in China at the moment. It was a big factor in the 5-year plan that was launched last year, and everybody's very focused on it now. A lot of multinationals I speak to they're really trying to bring R&D in China. They want to have R&D in China for China, so that you're really developing for the local market. So unsurprisingly, Chinese CEOs are very focused on R&D. 34% of them state that they're looking to expand organically through R&D, new product and recruitment. And just at the end of last year, the central government launched the Beijing Stock Exchange, which is very much focused on small and medium-sized enterprises. And then also in Shanghai, we have the existing Star Stock Exchange, which is very much focused on tech companies. And you can see a few differences if you look through the graph in terms of where they're planning to take actions. So whilst China and global, there's going to be increased investment in disruption detection. But then if you see, for example, joint industry consortiums based on innovative technologies, so, somewhat higher in China than global. And likewise, the third point there around accelerators and incubator programs for startup firms, 54% in China compared to 46% globally. I think this is really driven by the rapid emergence of a venture capital community in China, which is very fast growing. A lot of the big Chinese companies you would know, like Tencent and Alibaba, they have very active corporate VC units that literally make hundreds of investments annually, and they're partnering with companies and with funds. So there's very much a culture of this joint venture kind of approach in China, which perhaps in other countries is less established at the moment. Move on, please, Chris. The third one, the question was basically what do CEOs see as the greatest threat to business growth? And it's interesting here that there's considerable differences between the Chinese CEOs and the global CEOs. You can see for China, the top three are reputation, climate change, and supply chain. And then for global, top three are cybersecurity, supply chain, and climate change. Whilst, for example, China has cybersecurity right at the bottom. So what's driving this and this reputational risk, which is at the top of the list for China, but way down to global? I think we've looked into this a bit further. I think this is really a recognition from Chinese CEOs that their reputation and their brand are very valuable. As you would know, the very rapidly emerging and large middle class here, which huge consumer society with online acquisitions, e-commerce. The Chinese companies realize the value of their brands now, and they want to protect them, and that's affecting a lot of their e-commerce campaigns as well, which is really about promoting those brands and looking at their reputation going forward. They very much want to make sure that they're following government policy and not getting into trouble. Supply chain risk, unsurprisingly, both China and global being affected by that. It affects various sectors, which I'll come back to later. Again, a point on COVID, not only have we got the issues to do with international shipping, which is affecting the supply chain, but also in the last few months, as Omicron has hit China, we're having city by city lockdowns in especially some of the port cities like Ningbo, recently Tianjin and Xi'an, which is in central China. But when large cities like that are getting locked down, that has an effect on supply chain, depending on what factories are in those locations. Next slide, please, Chris. Oh, sorry, I'll hand over to Matt at this point.
Thanks, Mark. Hi, everyone. I'm Matt Jackson. I'm a director at KPMG based in the UK, focusing now on China for some 15 years for the firm. So I'm just going to run through the next couple of themes, which are very much linked around social responsibility and ESG. And particularly on this particular point, it's embedding social responsibility within the organization and the CEO's view on that. And the first thing to point out here is that more Chinese CEOs now view social responsibility as an integral part of their organization's corporate purpose. So you can see just under 2/3 say that their principal objective is to embed purpose into everything their organization does. So to create long-term value for all stakeholders, including consumers, employees, investors, and their communities. And this number, as you can see, increased significantly compared with the survey in early 2020, indicating that businesses are now paying more attention to the social benefits they can create. This is particularly interesting. I think the acceleration in China, it's something that's been around sort of Western businesses for longer, but the acceleration in Chinese businesses and the CEO mindset, has been noticeable over the recent surveys, and we'll see that around ESG as well. But by embedding CSR goals into business operations, the company is now able to improve production safety, product quality, employee benefits, and create a more equal and inclusive working environment. And most of the Chinese CEOs surveyed, 86% in fact, also believe that corporate purpose has an important impact on brand reputation. So promoting the coordinated development of enterprises and society has in effect become an important part of the corporations. And social, is the S in ESG, and of course is a key pillar within the ESG framework. And according to this survey, 81% of Chinese CEOs state that the pandemic has shifted their focus towards the social element, the social component in their ESG program. And that's up by 11 points from the previous year's survey. And within this sample, 3/4 believe that large enterprises have the financial and the human resources to help governments find solutions to the pressing global challenges, and nearly 30% plan to invest more than 1/10 of their revenues into sustainability programs. Next slide, please, Chris. So this is the focus on ESG and the China CEO's view on where they see the biggest demand on ESG transparency on the graph below. So ESG is becoming a core focus of businesses in China. Decarbonized regulations are expected to be implemented more systematically. This outlook reveals that in the context of a growing focus on ESG, there are increased demands from regulators and investors for more extensive reporting on ESG issues. And China's long-term planning for a shift towards green and low carbon development. And these goals include, and the emission goals call for the country to reach peak carbon emissions, as we know, before 2030 and carbon neutrality by 2060. And this is going to be implemented by the 1+N policy system. Now, to achieve these goals, it's estimated that China will need to invest, I think it's 100 trillion RMB in the coming decades, which will in turn present opportunities for businesses across a wide range of sectors, both domestic companies in China, but also foreign investors too. And in China's action plan for carbon peaking before 2030, one of the major actions relates to the action for green and low carbon society, within which enterprises will be encouraged to fulfill their social responsibilities. So back to the previous segment. And as mentioned, in the context of a growing focus on ESG, there are increased demands from regulators and investors for more extensive reporting on ESG issues. And China is indeed tightening regulation in this area. Some local governments have also released administrative documents requiring companies to disclose information on their greenhouse gas emissions. And our survey shows that 42% of China's CEOs acknowledge that domestic regulators, so this is the graph on the left-hand side and the bit in purple, 42% of China's CEOs acknowledge that domestic regulators have significantly increased demands for the disclosure of ESG information, higher than the global average, which is 29%, and up from just 5% in the survey conducted in early 2020. The bit on the right actually is interesting, and it focuses on the Chinese CEOs' challenges around communicating ESG strategies to the wider stakeholder communities. In effect, enterprises are stumbling in their efforts to communicate ESG information, and over a third of these Chinese CEOs say that they're struggling to articulate a compelling ESG story. The corporate leaders need to find a way for their financial reporting to meet the needs of different stakeholders, as we know, and make their ESG reporting as rigorous as their financial reports. And in fact, 22% of Chinese CEOs are concerned that they may face challenges in accessing capital markets should they fail to meet expectations from stakeholders on climate change. Next slide, please, Chris. So this is around the connected ESG strategy and financial returns. And while the CEOs believe that social and environmental priorities are key, they're less convinced about making the connection between the ESG programs and business performance. So over a third, 37% in the graph on the left, of Chinese CEOs believe that their ESG programs will improve financial performance, but 45% in the column below see negligible improvement. And it will be important to connect the ESG strategy with financial returns. The piece on the right is interesting. According to the survey, 75% of China's CEOs think their organization's digital and ESG strategic investments are inextricably linked. And a good example of this is the use of AI in China's wind power industry, which faces challenges in dealing with varying weather conditions and the oversupply of electricity compared with local demand, which is known as abandonment. By using AI, China's abandonment rate of wind power dropped from around 20% in 2016 to 3% in 2020, which is a significant improvement. Addressing global warming and achieving net zero emissions by the middle of next century not only requires effort from enterprises, but strong government support and leadership, along with international cooperation. And according to the survey, over 80% of China's CEOs believe that support from the government is critical in order for businesses to achieve net zero emissions. Now, furthermore to this, most of the CEOs identified COP26. Now, this was in advance of COP26 as being a pivotal moment that will inject urgency into the climate change agenda. It'll be interesting to see how the survey views it retrospectively. And just to remind those who aren't aware, who were aware, we did actually work with CBBC on a UK-China net zero, road to net zero publication, a report that was launched at COP26 in Glasgow, which looked at a number of case studies and areas along the key themes of COP26, where UK-China business can work together to accelerate climate action. And we believe that there is huge opportunity both for British companies going into China and for Chinese investment into UK net zero industry. So before handing back to Mark, I just want to mention that ESG reporting is permeating into subsidiary level at Chinese organizations in the UK and elsewhere globally, driven by international standards, directions at group level, headquartered in China, and also local reporting and disclosure requirements. And against which background, I shamelessly plug KPMG's new ESG IQ tool, which compares peer-to-peer performance around ESG key metrics. And we'll be very happy to talk to anyone interested in that. Back to you, Mark.
Thanks, Matt. Next slide, please, Chris. So the next survey question was to understand supply chain pressure. Not surprisingly, all companies, whether Chinese or global, are suffering with supply chain stress. And in fact, 60% of China's CEOs said that their supply chain had been under stress over the last 18 months, which was actually slightly higher than the global average. I suspect that's partly because China is so exposed to the global supply chain. There's so much export from China to the rest of the world, and for example, the shipping constraints that I talked about earlier, and they're actually going through the roof at the moment again. Very expensive, is really affecting Chinese supply chain. And then secondly, the points I mentioned before about COVID outbreaks within China. Particular industries being affected are retail, manufacturing, and automotive. Again, as many of you would know, the supply of silicon chips has been a major problem for over a year. And many of the auto companies I speak to in China are still suffering with that and trying to figure out what to do with it. I think actually what it's causing, quite simply, is accelerating the what in China in the 14th five-year plan was called dual circulation. So basically a more independent, self-sufficient economy. So in our deals team, we're seeing a lot of investment into Chinese semiconductor businesses. It's interesting in terms of these answers to the question in the graph below. You can see some differences between the ways that the CEOs are planning to mitigate that supply chain pressure. So the first one is about monitoring more deeply into the supply chain. Global at a higher level than China, 36% compared to 33%, but nonetheless, for both groups, it's the #1 mitigation strategy. I think that's also an acknowledgement of these days with the ERP systems and greater level of interfaces with distributors, for example, and the supply chain. You can get much greater awareness of what's going on. You can anticipate your potential problems. Second point, talking about diversifying sources and locations in the supply chain to make it more resilient. Interesting there, China slightly higher than global, but again, both groups seeing that as a major approach to mitigate the pressure. Finally, if you look at the bottom, you can see it's interesting. They're talking about onshoring the supply chain as a way to mitigate the risk, which for global is significantly higher than China. That has been talked about quite a lot over the last year about whether companies outside China would reshore supply chain. So it's interesting to see there's still 19% of global companies thinking about that. My own kind of on the ground anecdotal experience from deals and talking to clients is that most companies here, MNCs in China, that I don't see them talking about reshoring of operations in China to the US or Europe or wherever. Next slide, please, Chris. So this is getting into some of the tax reforms that were announced last year, specifically what's generally known as BEPS 2.0, which was introduced in July last year, which quite simply is, is about the proposed global minimum tax regime, which 74% of China's CEOs agree that is going to have a significant concern to their company. And you can see below where they see the impact of that. So many of them agreeing, actually, 70% plus agreeing about all of the 4 areas. So it's going to have an impact on growth, it's an impact on trust in our business and how tax approach aligns to our values, and pressure on the organization to increase public reporting of global tax, and then the impact of the pandemic. I think the point to mention here about BEPS 2.0, and it's something we've been talking about a lot in China, is that for global companies to be able to implement it, I think it only relates to businesses with global revenue over 20 billion euros. They really have to have an understanding of how much their revenue is to end customers on a by market basis, which means that in China, for example, multinationals are going to have to obtain data from their distributors about how much the end value of the sales are, and how much actually being sold. And quite simply, at the moment in China, there's very little transparency about that. So we'll see how that changes things within the Chinese supply chain. Next slide, please, Chris. Final slide on the survey. So this is about flexibility in the future of work. This is very interesting, especially if you compare China with the rest of the world. So 26% of Chinese CEOs plan to or have already downsized their office space, which is very different from the 80% that were talking about doing that in the middle of 2020. So there's been a significant change in approach. Back in summer 2020, where China was kind of just coming out of the first wave, the rest of the world was still struggling with it. And of course, working from home was the main theme that people were talking about. And there was certainly a lot of discussion about it in China. But actually, as many of you would know, in China, working from home hasn't really happened because the initial outbreak was that wave passed away relatively quickly, and we were able to get people back into the offices quickly. And certainly myself, I've worked in the office continuously since March 2020. And I think it's interesting, there's still 26% planning to further downsize. And what I see on the ground here in China is it's less related to COVID. It's more about retention of talent. There is a generation of younger talent now who are looking for a lot more flexibility in their work-life balance, and they are interested in being able to work more flexibly, not only in terms of location but in terms of timing. And for example, what was called the 996 culture that happened, was evident at companies like Alibaba and Tencent, that's starting to be challenged, and that's reflective of this. So, final statistic there is 54% say they're looking to invest in shared office spaces to allow increased flexibility. So we're expecting to see more investment in China into shared office space. Okay, so that's the end of what I wanted to present from the survey, and I think we can then pass back to Torsten.
Well, thank you, Mark and Matt. And before we open up the Q&A session, I'd like to remind everybody that they can ask the questions using our Q&A function, which is on the bottom. So please, if you have any questions regarding the survey or related the business environment in China, please don't hesitate and ask us. So I myself have a few questions. First of all, related to COVID, of course, which is still the most important topic. One of the most frustrating experiences, I think, for businesses, foreign business in China during the pandemic has been the very strict travel restrictions, and which has made it very difficult for many companies to travel to China, especially for like short-term visits. Do you have any experience on how this has impacted foreign and UK businesses that are operating in China? Are they what are the negative effects? Are there maybe even some positive implications on this? So yeah, so I'm just kind of interested to hear from you there.
Right. I think in the early days of the pandemic, for the first year or so, a lot of multinationals were finding it manageable. What I hear more and more now is that there is the gap in terms of understanding between the kind of the local management and the head office management about what's happening in China is growing all the time, because the people at head office just can't be here on the ground and see what's happening. They used to come multiple times a year and they could see the trends, they could see what they should be doing. And as a result, it's holding back some investment because the head office people are a little resistant, a little risk averse because they don't see it. There's been some success. I know some of the large chemical companies, for example, were very concerned that they needed specialist engineers to come in every few months to help with maintenance and resolve problems. Particularly the German chamber, German embassies were very successful, I think, with being able to fly in aeroplanes full of engineers to help with that. Admittedly, I think those people were kept in quite a tight bubble and perhaps for a short space of time, but it was a way to resolve the issue. The current thinking, I mean, there's no, from what I hear, it's still zero COVID policy. There's no, the question that all the expats in China, when they talk to each other, is about when does China open up? I think another question is, will it open up? Or thinking about what is the road to opening up? And I think on the one hand, we're getting these outbreaks now of Omicron, which perhaps might raise questions about whether zero COVID is possible. Yes, that's a question. But secondly, I think what's really needed is for an mRNA vaccine to be rolled out. From what I hear, there is one. It's in phase 3 trials at the moment in China, and that then needs to be rolled out as a booster for the whole country, and then perhaps gradually there can be more opening up.
Thank you. Just one related question, because you just mentioned the mRNA booster in the domestic Chinese development of such a vaccine. So in the West, of course, we have these vaccines like for 1 year, but so far China has dragged its feet in recognizing them. So there were some talks about like a Pfizer BioNTech vaccine, but Chinese regulators haven't really responded to that. And is there any chance that once there is a domestic mRNA vaccine, that China will allow foreign vaccines, whether it's Moderna, Pfizer, or even AstraZeneca, to be kind of at least recognized or kind of sold in China?
Good question. Yeah, but I think even a year ago, beginning of 2021, there was a lot of discussion about this Fosun partnership licensing to roll out their vaccine. In fact, AstraZeneca were as well. They were also in discussions about a partnership to roll out their vaccine, neither of which have happened, which I think, frankly speaking, is just desire from the authorities to demonstrate that China is self-reliant, that they can do it themselves. Now, if a Chinese mRNA comes on the market, I guess at that point maybe they would be willing to approve the foreign ones, but I don't think there's much likelihood that the foreign mRNA, Pfizer, BioNTech, for example, Moderna, I don't think that they would have much market access. They might technically be approved, but I'm pretty the whole vaccination program in China, as I think in most countries, is entirely government controlled. So you don't really have much control about what vaccine you're going to get, and you're going to a central hospital. So I would just assume that you're going to get a Chinese mRNA.
Okay. One other question that we received from a lot of members in recent months, which is not COVID related, but like related to China's recent regulatory changes. We've got a lot of requests regarding and confusion by members about China's new data rules, especially regarding data transfer, the security audit, which is required for kind of nearly all cross-border data transfer now. And there's a lot of questions regarding what should they do, what is legal, what is not. From my own research, I found that it's very much an ongoing process. So there's still also a debate within the Chinese government about how strict and should it be. So what is your impression, on the ground, of how these regulations will kind of impact businesses? How will they change? And what should we expect in 2022 on this regard?
Yeah, I mean, Torsten, you're correct. I mean, there's a lot of it's not very clear yet. It's all in progress. A lot of the clients I speak to here locally are nervous about it. You know, they're trying to understand what it means for them, what it means for the sustainability of their business. You know, there are some sectors that think maybe they can manage it, and others that are concerned. To give an example, I know the financial services industry are very concerned because you know, if you have commodities traders handling certain positions, the way most of these banks work is that they monitor those risks on a global level daily. And if you don't have full access to what your trading positions are in China, a global investment bank is going to have a lot of trouble mitigating that risk, because they would typically try to offset things elsewhere, hedging. So that's an example. But when I have most conversations with executives here, they more talk about, well, what's the future going to look like? If assuming that you want to be in China, which I think, you know, most people do, then I think the future in reality is going to be that the Chinese operations are much more autonomous than most MNC subsidiaries would be in local markets. It's not going to be a situation where you can have, for example, a global SAP that enables the global head of sales to see exactly what was sold yesterday in China to which customer. It's going to be much more limited information that's going to be available to the head office, which means that their local business will just need to be much more autonomous and be able to make decisions for themselves. You know, I can, and they're going to have local data servers on, you know, on the ground in China. If they're using cloud computing, that's going to have to be Ali Cloud. It can't be AWS, etc. So a lot of these things are being talked about, and things like there's the different laws. There's the data security law. There's also the personal information protection law, which is a bit like GDPR in Europe. And again, how much information can you share overseas about the information you have about your end customers and use that for product development?
Just one related
moment, still to be, a lot of it is still to be fleshed out and to be understood.
Just a related question, because when I read the new data regulations in the PIPL, so there's this requirement that companies need a data security officer or need to designate somebody. And it was, from my experience, I mean, like bigger MNC and large corporations, they probably have no problem with that. They have their designated IT teams, but smaller companies with a very light footprint in China, they are clearly struggling with this problem. So I was wondering whether there is an opportunity actually for service providers to provide these services, and can you see this kind of business evolving, or is it still like very much unclear whether that works like that? That companies can basically outsource this service to like specialized companies that can offer this.
That's an interesting idea, Torsten. I have to say I haven't seen that talked about. I think most service providers would be concerned about taking on that responsibility, because it's a bit like, my understanding of that, the role you're talking about is a bit like being a legal representative in China. So whoever that person is has got, you know, they're really exposed to potential penalties. So I'm not sure if a third party could take that on, especially if they wouldn't necessarily have full access to what you might call their client, to make sure they can ensure things are done correctly.
One final question I have is, you mentioned like the remote work in China, in the future of work, and how things went very differently in China compared to the rest of the world, where most work was kind of shifting to working from home during the pandemic. One question I had is, from my experience in China, is that the way people deal with technology is slightly different. So in the West, most people have computers at home. They have their own internet access. On China, so it's very much a mobile first kind of experience. We were always joking about sending emails to Chinese colleagues or clients, and you're never sure whether they're received or not, because everything happens on WeChat and mobile platforms. So I was just wondering whether that is actually feasible, like that people can just switch from the office to work from home, especially for like older employees who might not have a PC or a notebook at home. So how is this challenge kind of like, does this play in this debate about the future of work in China?
Yeah, I think it's still being thought about. I mean, we even at KPMG, it's something we're starting to develop policies around this at the moment. I think your point about internet access is that I would say most people in China these days have laptops. Certainly, KPMG, other companies, they do, so that if we need to send people home tomorrow because of the lockdown, they can work at home on their laptops. So don't see that as a specific problem. What can be a problem, I think it is exactly the same challenges as in the West. It's people living in small apartments, especially younger employees, perhaps still living with their parents actually, having the space to do work at home. And I don't know if this is the right time to go into it, but there are cultural differences in the way that people manage. I think China is very hierarchical, less flat management. I think managers want to be able to see what their teams are doing, and culturally, it's quite a big shift for some Chinese to deal with.
So again, if you have any questions, please don't be shy, use the Q&A function, ask away. Otherwise, I still have a few questions, if you don't mind. Last year, it was more niche debate, but it was quite important for international investors. There was this debate about whether Chinese regulators would ban the so-called VIE structure, like variable interest entities, which are quite important for tech companies, for Chinese companies operating in some sensitive sectors to at least attract foreign investment and allow foreign investors to become like passive investors. So it is a big issue for these investors. What is your view on that? Do you think that the signals from regulators are kind of mixed? Some say we should ban it, some say we should still keep it because it's so important for especially like startups and tech companies to attract investment. But how do you see this debate, and what are your kind of like predictions?
Yeah, I mean, just to highlight that VIE structures are mostly used by Chinese companies rather than foreign companies, and they're used primarily so that they can list on offshore exchanges, or in particular the Nasdaq. So all the big Ali and Tencent, etc., Baidu, they all used that structure when they were trying to get access to foreign capital. Now, I think what's going to happen is that given, and this is in some way triggered by the US regulations, why is it that we're now seeing quite a big flow of Chinese companies delisting from the Nasdaq and relisting in Hong Kong? one effect of that will be that the VIE structures will disappear. They won't need them anymore. So a recent example, you mentioned the tech and the education kind of crackdown. I think the DD thing was around that time when they actually were planning to list, when they were planning to list on the NASDAQ, but they're now going through the process to list in Hong Kong. So whatever VIE structure they may have had is going to disappear. And I think if you're talking about foreign companies, these sectors, like the tech, basically is so regulated, it's very difficult for foreign companies to access.
Okay, we're still waiting for questions. I have another more general question. So you mentioned that Chinese companies the Chinese government wants the Chinese economy to be more self-reliant. So we had this discussion about dual circulation. We had a discussion about the domestic mRNA vaccine. One thing I'm surprised is that this is in a way is not necessarily a new policy approach. So we've seen that like in the last century, like especially like Latin American countries, that we try to kind of like pursue a policy of like import substitution and kind of like the strengthening of domestic industries. So this is nothing new in a sense. And one effect that this had on global trade in a way, and on the national like accounts, is that it actually drove up imports. So we often see that in the media that this policy is debated as, okay, like this is like a technological competition and will lead to decoupling, while the actual, say, historical experience actually says it's what it means is actually more imports for China, which also has like the knock-on effects on prices and potentially like inflation. Do you see any some of these effects already happening? So that we have like, I mean, we have like the shortage in the semiconductor industry, but that we suddenly see like more companies competing for finite resources and supplies. And what is your kind of like view on this?
There's certainly greater competition around the supply chain, which the things we've talked about already. I mean, that's what caused the power cuts to some extent. I mean, they were trying to meet some of their environmental standards that then set in place the ESG points that Matt explained earlier, and therefore reducing power consumption. So all of that creates bottlenecks in the supply chain, which certainly is creating problems. It's creating inflation, but I don't think at the moment I see it increasing imports.
Okay. So if we don't get any questions from the audience, then maybe let me ask one last question before we wrap up.
Question to Matt, mate. Ask Matt a question.
No, I lost a. Give me a sec.
There's actually, sorry to interrupt also, there's actually a question that's there in the Q&A about
oh, I think we got one, yeah.
Climate change.
Yeah, so any suggestion as to what is driving CEO concern around climate change? Is it consumer driven or government driven?
I really think it's both, actually. And as maybe I'll hand over to Matt to complement this point, but I think you've got the government in China implementing these regulations, and that's why you saw that rapid change in the graph that Matt showed earlier. That suddenly ESG was an issue, but then I think the whole world now is aware of climate change. We've had, what was it called in Yunnan, Matt? COP 20. the other one, the one before COP26.
COP15, biodiversity.
COP15, thank you. Yeah, obviously, very numerically. And COVID itself has made people think much more aware of the impact of climate change, as we saw. The impacts of people not driving, people flying less. It's all affected the environment. So there's now a new generation that are seeing that. Anything to add, Matt?
Yeah, I mean, the new generation piece, I think, is important, Mark. I think some of the surveys and reports that we've produced out of the China firm on the Chinese consumer, point markedly to the the Gen Zs as being completely different in their mindset in China, and that, of course, drives the CEO action, right? If your customer base is more environmentally focused and aligned towards climate action, then your behaviors as an organization change accordingly. So I think it's both. It's government and it's consumer driven.
We've got a second question from Sam Ashcroft. How do you see the future of Chinese companies development overseas? Brands such as Hisense, Haier seem to be continuing to have success developing themselves as international brands. Do you think that increased regulations regarding international investment are going to hamper these companies, even in non-sensitive industries?
Right. Yeah, I can comment on that. I think the big picture is that both pre and post-COVID, Chinese outbound investment has reduced considerably. I mean, really a large factor, which has been driven by a whole load of things. It's due to recognition that some of the previous investments were successful. It's a pivot away from Europe and North America towards Belt and Road. It's identifying companies, like Fosun and Wanda and others who were over leveraging their investments, which has created H&A as well, creating a whole load of problems. So outbound investment in terms of M&A has drastically reduced. We are seeing it starting to come back, but it's going to be in more what you might call friendly countries, particularly that are those that are involved in the Belt and Road. Now, regarding the specific question, I think there are some Chinese brands that have become established as global brands and are doing very well. So yeah, Hisense, Haier. I would also add NIO to that, which is who doesn't know, Chinese EV company, which I believe are about to launch in Germany. So it'd be really interesting to see what happens with them. So I think that in terms of especially organic growth of successful brands, sure, they could be successful.
And we've got one third question by George Qin. Which sectors of Chinese CEOs is the most optimistic about China and the global economic outlook, according to the survey?
I'll have to get back to you on that one. I don't have the breakdown by sector.
Okay.
But as a guess, I would say automotive, tech, financial services.
Okay, if we don't get any other questions, then I remembered my question because you, Mark, you addressed it briefly during your presentation. There was what are the plans of Chinese companies to continue their offshoring of low value added production capacity? I remember that when I researched the energy crisis, that one problem was that a lot of companies, especially in the textile industries, were running above capacity because countries like Vietnam or Bangladesh were in lockdown. So kind of like a lot of this production kind of returned to China, and they became like the producer of last resort, basically. But a lot of managers were actually expecting that this production would then return to these countries once the pandemic is over. So do you see similar trends in other industries, or what is the kind of the general trend? Is it still continuing to kind of like in terms of like offshoring, or is there anywhere where we see a reversal of this trend?
I don't see the offshoring happening. To repeat the words we've mentioned a few times already: self-reliant, dual circulation. I think everybody's focused on having basically an independent, self-functioning economy. So, in terms of anyone who was looking to offshore before for labour cost reasons, there's an awful lot of automation. You mentioned, so we didn't mention media. They're also a very successful company. They acquired KUKA, of course, a few years ago, German robotics company. And you see KUKA all over China now. So I think there's an awful lot of transformation going on to make sure that the whole supply chain remains competitive.
Okay, I think so it's like now it's 10 a.m. I think I would like to thank Mark and Matt again for their very interesting presentation. If you have any questions that you couldn't ask during this presentation, feel free to contact us, and we will try to answer these questions like as soon as possible. So thank you again, Mark, Matt, and Chris, and to all the participants who joined us this morning or afternoon. And we hope we can link up and see you soon again. Thank you very much.
Thank you.
Bye-bye.
Bye.